Hello everyone, welcome back to another lesson of ARR, or the average rate of return. In the last video, we talked about what is the average return or the ARR, and we run through together with an example question of ARR. We end the last video with a practice question of machine B, where the initial investment of the machine B will cost £310,000. In addition to the initial investment, there is some additional cost of £15,000 per year for using the machine. The cash flow that can generate by the machine will fluctuate around £125,000 to around £140,000 per year. Given this information, students are asked to calculate the ARR and to compare whether the current machine B is a better investment or is it the machine A from the last video. First of all, we have to calculate the net cash flow. So the net cash flow today, which is year 0, is this no money inflow, 0, minus the 310,000 initial investment of cash outflow. Therefore, our cash outflow for the year 0 today is a negative £310,000. In the year 1, the cash inflow or the revenue is 125,000, and we have to subtract the cash outflow of 15,000. Then this will give us a net cash flow of positive £110,000. In the second year, the revenue is 127,000 and the expenses, which is the cash outflow, is £15,000. Therefore, it gives us a net cash flow of positive £112,000. And then the third year, as more customers know about the machine, they start buying more. Therefore, there are 140,000 sales. Again, every year we have to pay £15,000 for using the machine. And if we subtract 140,000 by 15,000, then it gives us an answer of £125,000. The fourth year, it has the same revenue at 140,000 and we have to pay expenses of £15,000. Therefore, it gives us a same net cash flow of £125,000. And in the last year, there is some decrease in sales to 130,000. And again, we have to pay expenses of £15,000. Therefore, it leaves us a total of £115,000. To calculate the average annual net profit, first of all, we have to do is that the total cash flow, we have to divide it by the life of asset. And to calculate the total cash flow, we have to add up all of the net cash flow. Therefore, in this case, it's a negative 310 plus a positive 101,000 plus a positive 112,000 plus a positive 125,000 plus a positive another 125,000 and plus another positive 115,000. If we sum up everything from the net cash flow, then this will give us a total of a positive £277,000. In this case, this £277,000 is the total net cash flow. Then we have to divide this by the life of assets. In this case, the life of assets is this column here. So we do not include today, and then we include the rest of the years. And then, as you can see from this table, the life of asset is 5 years. So in this case, the £277,000 divided by 5 years for the life of asset, then it gives us an average of 55 17.4 thousand pounds per year. To calculate the average rate of return or the ARR, the step 2 is that we have to divide the average annual return by the initial investment. And after that, we have to multiply by 100%. In this case, the average annual profit is this 55.4 thousand, and then we have to divide this with the initial investment of 310,000 pounds. And then we multiply this by 100%, and this should give us an answer of 17.9% for the machine B. Now, if we have a look again at the ARR of machine A, you will see the ARR of machine A is 10.2%. And the ARR of machine B, the machine B ARR is 17.9%. In this case, we can conclude that the machine B is a better investment based on the ARR method. I hope this video helps the student to strengthen their knowledge to calculate about the average rate of return. For now, many thanks for watching this video, and I will see you in next one.